Hey guys, Akil Stokes here. Welcome back to the Trading Coach Podcast. Today I'm going to share a few 20 lessons from old traders. That was the title, but I'd like to say experienced traders because now that I've shifted into that old category, experience sounds a lot better. So yeah, we'll go with that. Now, before we hop in, this is another video episode of the Trading Coach Podcast, so make sure you hop over to Spotify or YouTube to check it out. I also got a note that Apple, I believe, is going to be doing video episodes soon, so I haven't confirmed that, but once it does, now you Apple Podcast people can watch video versions over there as well, which is awesome. So let's hop in. The idea for this podcast came from a tweet that I saw by a good trading buddy of mine named Steve Burns, who pretty much asked the question, experienced traders, share some of your greatest trading lessons. And after going through about 100 plus different responses, I wanted to pick out the top 20 and share them with you. Now, I may combine a few of these, so don't fact check me on if it's 20 or 23 or 18. The idea was to go with 20, but I have a thing where I kind of like take things and put it together to simplify it. So it may be a little less, but who's counting? But I do want you to pay attention because after this video is over, I would like for you to share the top 3 trading lessons that you heard from either this podcast here, or if I left something out that you thought is very important, maybe a particular trading lesson that you have on your own, share that below as well. Ideally, I want to gather what you guys say, pick out the top 4, whatever like that, put it in a poll question because I've been really in the poll questions lately and really get an understanding of what you guys value the most when it comes to trading. So participate if you can, please. It will be very helpful for some future discussions. All right, so let's hop in. The first one actually came from a trading vet, a famous trading hedge fund manager out there going by the name of Tom Basso. And Tom said, make sure your position size is correct on every trade. And there were a few that I want to combine with this as well. Another one was protect your capital above everything else. Without capital, no strategy matters. You don't get paid for being right once. You get paid for staying in the game. Survival is the first edge. And I've always been told that good traders are great risk managers, and this falls right into that category. I was also told by one of my mentors that the 2 things you need in trading are a chip and a chair. And that's a poker reference, meaning that if you have money, you can have a chair at the table. If you have a chair at the table, you can participate in the game. If you can participate in the game, you have a chance to win money. However, if you don't have a chip, meaning you are broke, potentially from lack of risk management, then you can't be in the game. If you can't be in the game, then you don't have a chance to make money. So it really is survival is key. As long as you have an opportunity to be in the game, you can play the game and benefit from it. But if you blow everything right away, then you're out the game. Something else I want to touch on with this one as well is the quote that said, you don't get paid for being right once. And I think this is something that a lot of newer traders get caught up in, happened to me as well. But imagine yourself learning about trading, you hear all this stuff on the internet about making so much money so quickly, and you get suckered in because it's like, oh man, that sounds cool, I want to do that. And you really have no idea what you're doing. You're in that unconscious, incompetent stage where you're a trading baby and you don't know what you don't know. But the one thing you do know is how to push the enter button on your keyboard and enter a trade. So you do that. You have a 50-50 shot of whether price is going up or going down. In this case, price goes in your favor. You win big and you think you've made it. The problem is that's only one win, and you can't be a successful trader off of one win. It takes consistent profitability over a long period of time. So you can get as excited as you want over that one win, but if you don't follow it up the next trade, the next day, the next week with consistent winners and all you have is a flood of losers, you're going to be out the game pretty quickly and then you're done. Now the next one, and remember this is in no particular order, they're not ranked in importance, just the order in which I grabbed them and typed them into my notes deal, but it says be slow taking profits, but be fast in taking losses. And we've discussed this old trading saying before, and some podcasts, right? I don't expect you guys to remember everything we said in all 1,300 of these podcasts or whatnot. But one warning I had about this was that the idea of the saying makes sense, but don't take it too literal. Meaning, the idea of being slow in taking profits and being fast in taking losses means that you want to maximize your gains. Meaning, and by maximize, I mean take whatever you are expected to take from your gains. And by expected, I mean when we enter a trade, we should know three things. We should know entries, we should know stops, we should know targets, right? Entries are where we get in, how we get in. Stops are our protective stop loss. We'll get to that a little bit later, like where we want to get out when we're wrong. And targets are where we want to get out when we're right. Now, the problem with the verbiage, I guess, of be slow in taking profits or let your winners ride is that a lot of traders think that means never take profit. Like market's going up towards your profit level. If profit level is here and market is right here, you think, okay, well, I'm going to move that profit level away because this thing can go up higher. And then what happens is maybe it does go a little bit higher and then you go to get a drink or go to the bathroom and you come back and it's much lower and you end up getting less than you expected. So there is a negative side to that because nothing goes up forever. Something will, or everything will eventually go down. But when we talk about being slow to take profits, what it really means is that we don't want to prematurely take profits. We want to trust ourselves, trust our analysis, take our profits out at the level in which we expect it market to go to. And that doesn't mean all of the pips in the world, just whatever you wanted to get from the trade, and then get out and reevaluate for the next opportunity. The same thing when it comes to stop loss, right? Being quick, right? That hurt. Being quick in taking your stop losses doesn't mean taking your stop loss prematurely. Doesn't mean you enter a trade and then the market goes boop, one tick lower and now you're like, panic, take my stop loss out. Like, no, you still have to give it enough room to breathe. What they mean by that is that you want to take your stop losses out at the place where you've identified that you're wrong, and you don't want to let your loss get bigger than what it's supposed to be. And hopefully if you're doing a good job as a trader, when you analyze the market, the place in which you put your stop loss is the safest place that you can put it. Meaning, yes, it gives the market enough breathing room to do all its funky little weird stuff and dance around and sucker all the new traders out of their money. But it's not too far away that you give up too much exposure or have too much risk when it comes to the trade. All right, next, don't try to predict. And this is kind of a combo one. Don't try to predict. What? We'll get to that later because some of you guys have the big eyes like Akil. Trading is all about making predictions, isn't it? Yeah, kind of. But don't try to predict. Know what you're going to do if it goes up. Know what you're going to do if it goes down. And then very similar to this was trading is not about knowing what will happen next. It's about knowing what will you do with whatever happens next. So yes, as traders, we are making predictions, right? I've bludgeoned into your skull the 4-step process IPDE: identify, predict, decide, execute. So yes, I'm not going to say that you shouldn't make predictions, but understand that predictions are nothing more than educated guesses. Predictions don't mean that we take the trade right away. And something I always tell our traders is that we want to be predictive with our analysis, but reactive in our execution, which means that I want to predict using an if-then syntax. If price does thing, then my prediction is that price will go to there. Now, just because I've made that prediction doesn't mean I'm saying, if price does thing, buy right away and it'll go to there. No. If price does the thing, then I'm waiting for the market to give me a clue that my prediction is more likely to happen than not. So we are making predictions, but rather it's understanding how we're going to react to the new information that the market gives us. So I hope that makes sense. Because we never know what's going to happen next, but I do know what I'm going to do if said thing were to happen next. And I just realized I left a part of that statement out. At the very end, it said, so the number one rule is preparation. So everything I told you about if then, if market does that, then predict that, IPDE, all of that is preparation. Next one, and this is more of the psychological side of things. Get to know yourself as intensely as you can. Face your fears, be brutally honest with yourself, have faith. The journey is one of a kind, but it's so worth it, guys. That's so heartfelt and delightful. One of my best trading friends, someone that came up with me when I was learning how to trade, we were very bad together, and that's how we formed this forever bond due to our badness and pain in the market. He once told me, he said, Akil, trading is a journey of self-discovery. And I'm like, Lex, what the hell are you talking about? Trading's about making money. He said, no. Listen. The more you involve yourself in the market and the more you understand what makes you tick and how this makes you feel and how you react, the more you understand about yourself. And before you know it, trading is going to affect your real life just as much as your real life is going to affect your trading. And I was like, Lax, you're crazy. But Lax was 100% right. And obviously, trading has affected my real life, and I've changed a lot for the positive in how I do stuff in real life. I've become more robotic in real life as well, but I guess that could be positive. But anyway, understanding myself has been a massive change for me in my trading, mainly on the psychological side, but as well on the technical side as well. So I guess we'll talk about both. On the technical side, being able to understand myself and being able to understand myself comes from my experiences in the markets. I know what makes me tick. I know what makes me happy. I know what makes me sad. I know what makes me scared. All of this is kind of information that we're taking in that we start to kind of put in our brain and mold our own trading style around. So from a technical perspective, my trading style is molded around the person that I am. I am not super conservative in real life, but I'm not super aggressive either, meaning that if I'm at a red light, I will certainly cross. I don't need to follow the rules. But if there's a car coming very fast, I'll probably just wait until that car goes first, right? In trading, it's the same way. Although I do have some strategies where I enter on an aggressive limit order, you're not going to see me with any of my price action strategies just put a limit order at a level and be like, let's go, baby, right? I'm going to wait for price action to get to that level. And then I'm going to wait for a signal for a potential reversal and involve myself in that first signal. At the same time, I don't need a super powerful signal to get into the trade, right? So I'm kind of in the middle there, just as an example. Now, from the psychological side, this is helpful as well because over the years, I've grown to understand, again, what makes me tick in the market and what mistakes I'm good at making, bad at making. I'm good at making bad mistakes. Is that good? Is that bad? That's bad, right? Yeah. I used to be good at making bad mistakes. Now I'm bad at making good mistakes. No, I'm bad at making bad mistakes. I don't make as many mistakes because I've learned why my mistakes occur, what triggers those mistakes, and I've learned to avoid the situations that cause me to be in that mistake. I've told you guys the dark alley reference, right? And I'll tell you again, growing up, right, in the mean streets of Philadelphia, Pennsylvania, where a lot of bad things happen at night, my parents always told me, Akil, if you want to give yourself the least likely chance of getting shot or going to jail, don't put yourself in situations where you may get shot or go to jail. Meaning, don't be out on the streets at night, 2 o'clock in the morning, because that's when a lot of bad things happen. And by simply avoiding the time when bad things happen, those bad things are less likely to happen to you. Makes perfect sense. And the markets are the same way. If you know you get all extra excited and pumped up during non-farm payroll because everyone's talking about it, you just want to trade, and although you're not supposed to trade, you always do it anyway because you have that gambler's mentality. An easy way to not tempt yourself to trade during a high impact news event is just don't be at your charts or on your phone during a high impact news event. Purposely schedule something at Friday 8:30 to distract you. That way you don't have the opportunity to do the bad thing and not be good at it. Yeah. Next, let your focus be on improving, not proving. Yes, really good one. Old head traders like myself, very easy now because we're old and we don't care about what anyone else is doing. Younger traders, very hard, right? So what this means is that the focus should be on you. You should not care what anybody else out there is doing, whether they're making money, whether they're not making money, whether they have this new strategy or whatever it is, right? You're only worried about yourself and being the best that you can be. Easier said than done, because as a newer trader, one, we don't have a lot of confidence. Two, we're probably coming from a situation where everyone in the world told us that trading is a scam, aside from the scammers who tell us it's not a scam, interestingly enough. And we want to prove to everyone that we know what we're doing, that it's not a scam, and that we're smart and we're not like the dumb person in the class. And when we do that, we tend to do extra. So it's like, here, I've given you, I did a video today. I told you I had a win streak today. I've done videos in the past where I've came in and said, hey guys, Akil Stokes here. Welcome back to the Weekend Trading Edge video. I've taken 5 losses in a row, right? And I'm completely comfortably telling you that because I don't really care what you think. All I care is what my brokerage account says. So you can judge me in the comments for taking 5 losses in a row. You can say, I suck, I'm bad. People have said my methods don't work. I've gotten all types of crap said about me. And I just don't care because it doesn't affect my money. And that's what I care about. But as a newer trader, when we have a bigger ego and something to prove, we don't have the luxury of trading 15 years consistently profitably and having that be the track record that you can rely on for your proof. You have to kind of prove something. So when you take 5 losses in a row, you got to go out there and get a win really, really, really quickly, because if someone asks you about your 5 losses in a row, you don't want to feel discouraged or dumb or whatever like that. So a lot of traders make mistakes trying to prove something either to other people or prove something to themselves. And what really happens is they just put themselves in a worse position because they're doing stuff that they shouldn't be doing. The key should be consistent improvement, right? Kaizen philosophy, right? Continuous change. Get a little bit better each and every day. And over time, just like compounding, you'll be so much better than when you started. The greatest example I have of this is really the game-changing story in my trading career when I hit rock bottom and I finally realized / accepted the fact that I was bad at trading, not because of strategy, broker, president, conditions, mother-in-law, you name it, right? But because of me. And I did the thing, the big A-B split test, right? The little T-chart, and I said, here's what my trading should have looked like. Oh, that's good. Here's what my trading did look like. Ooh, that's bad. And I found out that it was bad because I wasn't doing the things that I was supposed to do. And I went back and listed all my mistakes, and I realized I was making like 30 mistakes a month. So Kaizen philosophy, continuous improvement. I didn't go out and say, hey, I'm going cold turkey, no mistakes on January 1. I said, hey, if I'm averaging 30 mistakes a month, my goal for January is to get through January making only 29. And then whatever I made in January, I would want to do at least 1 less in February, and at least 1 less in March. And if I continue that path of getting a little bit better each time, eventually I would be at 0 mistakes. So again, it's not trying to do everything at once, just slowly improve, learn the lessons, which I believe is another one in here. And before you know it, you'll get to the place that you want to be. That actually goes to, I'm going to skip one here, but it says start slow, make mistakes, but don't repeat them. So that goes hand in hand with what I just told you. It is okay to make mistakes. Trader, you, listen, come on, zoom in some. It is okay for you to make mistakes. You are a human being. It is going to happen. Yours truly still makes mistakes to this day. However, you don't want to consistently make the same mistake over and over again, because that would mean you are dumb or you're not in control of yourself. But I like calling you dumb because it's more direct and hopefully it scares you a little bit. So understand, yes, you can make mistakes, but with proper journaling and whatnot, you should be able to identify what those mistakes are, what's causing those mistakes, and you, right, come here again, right? You need to make it a goal not to let that same mistake happen again. And if you can consistently do that, that mistake will be gone. You'll build a new habit. You won't be tempted to make it again, and you'll be improving as a trader. All right, back up to the one before it. Play in probabilities. No one knows the outcome of any given trade. We kind of spoke about this earlier, but and another one I'm sure I'll read is called process over outcome. Understand that we don't know the given outcome of any given trade. We can have the best trading opportunity in the world and it can lose. We can have the worst trading opportunity in the world and it can win. Real quick, I have a great trading opportunity on the board right now, and I just noticed I haven't checked it and the hour just turned. Let me just see if it's doing good. It was one of those great trading opportunities. It's at break even. No, it's up a little bit. What is it up? About 10 pips. So it's kind of back down from halfway to targets. Anyway. The point is, we never know the outcome of any given trade. Therefore, we shouldn't judge ourselves too harshly off of the outcome of any given trade. We are working with the law of large numbers, meaning that we are working with the big picture. It is very similar to a basketball player. Let's take Steph Curry, for example, who is the greatest shooter of all time. Steph Curry, let's say he goes into an NBA game and he shoots the ball 20 times and he makes it once, right? Probably the worst shooting night ever in his career. Are you telling me that the next game you're not going to give Steph Curry, the greatest shooter of all time, the ball? No, because he's eventually going to even himself out, right? So that means the next game, he'll probably make 20 of 20 shots and bring that ratio back to where it should be. So trading is the same way, right? We understand that we have an edge. We should know our numbers, what our edge should provide us, and know that those numbers only come to fruition bigger picture. I'm talking like end of the year. So our job isn't trying to pick and choose or panic whenever those numbers don't go our way. It is to consistently follow the process, play those odds just like the casino, meaning we are the casino, not people playing games at the casino because they don't have the edge. We have the edge. We are the casino, and our job is to consistently get people into the door playing our games because there are going to be a few big winners, yes, and we got to pay them out every once in a while. But overall, the more people that come in and play means the more people that lose money. The more people that lose money means the more money that we get being the casino. So we have to know our numbers. Don't get too crazy over any given trade or any short-term stretch of trade. Play the long game. Next one. Just talked about this on the chat with one of our traders. Follow your stop loss. No exceptions ever. I would like to bold that and highlight it as well. That one rule will save you from 90% of catastrophic losses. Blown accounts don't happen from bad entries. They happen from refusing to exit when you're wrong. Honor thy stop, protect your capital, live to trade another day, everything. I told you guys a story about how my dad told me growing up, stay out of dark alleys at 2 a.m. in the morning. Another lesson that my dad told me is always use protection. Yes, always use protection. Trading is the same way, right? So I was talking to a trader on our platform a few minutes before I started recording this. And by the way, if you want to join our platform and hang with lots of cool traders, meaning like-minded individuals, you don't seem like a weirdo outcast by yourself, check us out, www.tier1trading.com. And we're talking about, he asked me a question and he said, man, I'm sorry if that was a dumb question. I said, hey, there's no such thing as dumb questions aside from if you're asking a question, do I not need to use a stop loss? And I said, if that happens, then I reserve the opportunity to call you dumb. He said, yeah, that and jumping off a cliff with no parachute. And I said, you know what? At least when you jump off a cliff with no parachute, there's a bottom. When you trade without no stop loss, it can go down forever. Remember the last video? Euro Swiss? Put the chart back up? Yes, it can keep going down past your zero line and put you into the negative, and that is not fun, right? So yes, you want to use a stop loss. Protection is key. And I like what this says is that, about blown accounts don't happen from bad entries. They happen from refusing to exit when you're wrong. If you are setting your trade up the right way, entry, stops, and targets, you are predefining your risk, meaning you're saying that if I enter this trade, I am going to risk 2% of my account. You've done your math, you know what 2% of your account is, and hopefully in doing that math, you said, okay, I can stomach losing 2% of my account. That's okay. I'm willing to accept that risk. It's no different than taking a poker chip and saying, I want to play this game. Here, I'm going to ante up. I'm going to put that much on the poker table. So if you take a loss on that trade and you lose, you've only lost 2%, a percentage that you're pretty comfortable losing in the first place. So it's like, it's not a big deal. You can lose 2% over and over and over and over again before you get to a point where you have to really reconsider things, right? So you're giving yourself freedom to not be bad, but to take losses, right? To have that bad shooting day. However, if you don't use a stop loss because you're cute or because you think that the broker is manipulating you, which is the stupidest thing you can ever think of, right? Your broker doesn't want you to go broke. Your broker makes money off you trading. Why would they want you to go broke? But if you're doing stuff like that, now you can still have that same loss, but instead of that loss being a measly 2%, that loss may be like your whole account. You may hit margin call and then you're done. And as the trader wrote, he said, this rule will save you from 90% of catastrophic losses because losses don't kill traders. Catastrophic losses kill traders. So why risk it? Next one, this is simple. Have a plan and follow it. I say it at the end of our video. Plan your trade your plan. If you don't have a plan, a rules-based plan, I should say, how do you know what you're doing? You don't know what you're doing. I'll answer that for you. You are doing randomness. And if you take random actions, you get random results. And that's why you're not profitable in trading. Next, here's a little bit about journaling. Track and record everything. Your thoughts, emotional state, etc. Most new traders think P&L is the only thing that matters. Process over profits. You spoke about this a little bit before about knowing thyself as trader and entering your Zen state. This is why you need to journal. You're not going to understand what makes you tick. You're not going to understand what you're good at, what you're bad at, unless you take these observations or make these observations and write them down. So you need to journal. P&L is cute, but I'll tell you what, after years of trading, you're going to get so bored with P&L that it won't even matter because, again, there's going to be no individual trade that makes a difference. You're just going to, we had a conversation in the live room yesterday about trading is boring. And I'm like, yeah, I look at my P&L like once every 3 months, right? Because like, well, I'm going to look at it after every trade. Like I know what I made on the trade. I don't need to see my account tick up or tick down. It ultimately doesn't really matter till the end of the year. So like, what's the big deal? So when journaling, what's more important than just the P&L is all of the other things. And all of the other things is what most traders don't track. And that's one of the reasons that most traders aren't successful. Next, we're going back to the technical side of things. Always mark your key levels and wait for confirmation. Tight stop loss does not matter if it's hit. We'll kind of break this up into two things. One, always mark your key levels and wait for confirmation. That is key. That goes back to being prepared as a trader. Something I have in my daily checklist, and you guys have seen me do this on the charts for you guys that have been with me when I live trade, is I go through this process and I start by identifying 4 levels of structure, right? The direct levels above and below where price is trading at, and then the levels below that and the levels above that, because those are my predictions. I say that if price action does A at this level, then it's likely to go to this level. If price action does B at this level, then it's likely to go to this level. So I'm literally marking up my charts and running through that kind of future prediction process of, okay, this is what I need to pay attention to now. This is what I need to pay attention to next. And that makes my trading day very easy because I pretty much just wait for price to go from one level to the other. Yeah, I know. Pretty boring stuff, but boring trading is good. The second one goes back to the tight stop loss. You spoke about stop losses a little bit earlier and how you should always use one. If not, you're dumb. But we want to give stop loss breathing room, right? We want to we think we want to have a tight stop loss because it's going to save us money, which isn't necessarily true, especially if you're using a fixed percentage style of risk management. You're still risking whatever percent per trade. But you want to be very smart with your stop loss. I think I know too many traders use random stop losses, meaning like they have a method where it's like, hey, 10 pips below the entry or this or that. And it's like, well, yes, I'm proud of you for having a rule for your stop loss, but was there any thought that went into that rule, or did you just say, I need a rule, let me just create something, right? Stop loss placement should be the same analysis that you use with your entries or with your target placement, right? You need to analyze the chart and figure out where is that sweet spot that I can, sorry, that was the Dr. Pepper commercial with the little guy that looks like Prince. He always does that. And I have a friend that looks like that little guy. So whenever I see him, I'm like, yo, what's up, man? It's a sweet spot. And it's a thing. But the point is, we need to do analysis to find out where the sweet spot of that stop loss is, meaning kind of like the Goldilocks and Three Bears, right? Is it too close? It doesn't provide me enough safety. Okay, I don't want that. Is it too far? Well, that's going to give me too much risk. Where's that spot right in the middle where it's avoiding whatever levels I want to avoid to give me safety, but it's not so far away that it gives me extra risk? So we do have to analyze our stop loss. It isn't just something that you pluck on a computer and be happy about, because now you can say that you're not dumb because you actually have one on. All right, so the next one is, this is a good one. Your strategy won't save you, your discipline will. I should have done it in a Yoda voice. Hold on. Save you, strategy won't. Discipline will. Right? That's bad, but you get what I'm saying. Real Yoda, not little baby Yoda. But this is a good one. And they go into the other part of it that I missed was trade like patience is your only edge. Everything else is noise. And this goes back to trading being boring, right? The truth is, most professional traders don't actually trade as much as you may think. Now, obviously, it depends on your trading style. An active day trader on a lower time frame is going to trade much more than someone that trades the monthly chart. That was another comment in here that said new traders should trade the monthly chart. That's a bogus one, but maybe I'll do another podcast on the top 20 dumb pieces of advice that were in this list. And then swing traders are going to be in the middle. So understand that first and foremost. But if you had to guess how many trades I take per month, and I'm a trader that trades on 1 hour and 4 hour charts, I trade about 9 different pairs, and I trade a handful of different strategies. What would you say that number is? You can pause the thing and think about it. You can comment below if you want to leave that comment. Maybe I'll do a poll question about it and see what people actually think. But I take about, at this point in my career, about 15 trades a month. This is why in the last video, I was so excited where I'm like, hey guys, after a slow start to February where I had like 3 trades this month so far, I got 4 in the last 2 days. Like that's why it was like some of you guys are like, well, 4 trades in the last 2 days. I did 4 trades in the last 2 hours. Like for me, that's massive, right? So I don't trade nearly as much as you think, and most traders don't do. And it's because I look for quality of trade over quantity of trade. I don't just care about being in trades. I'm just giving my broker money when I do that. I want to involve myself in the best trades. And one of my mentors always told me, Akil, you should look for the trading opportunities where there is a brown bag on the ground with a note that says free money, and those are the only ones that you take. However, in real life, if you ever see a brown bag full of money, leave it alone. It's drug money. Someone will come after you. Trust me. But the point is, when trading gets boring, when the markets slow up, traders instinctively feel like they want to trade, right? Basketball, right? Shooters want to shoot, traders want to trade. So they're sitting there, nothing's happening in the market. And then you start creating stuff. You're like, man, nothing's there, nothing meets my plan. Oh, look at that. That looks good. What does social media say? Oh, Akil just put out a video. 10 reasons to get long the euro dollar right now at the time of reading this. Yes, I'm talking to you. Oh, talking to me. Okay, huh? Oh, okay. Well, 3 of those reasons just fit. Akil just updated the comment. Hey guys, I'm short right now. Join me. I'm in, right? And you do dumb stuff, right? You become undisciplined and you take trades you're not supposed to take. When I do evaluations of traders, especially ones going through rough periods, the first question I always ask is, okay, are you in a natural or a self-inflicted drawdown? So a natural drawdown means that you're doing everything correct and your strategy just sucks for whatever time period it's been, right? So I'm like, okay, tap yourself on the back. You suck, but it's not your fault, right? These are wise words and motivating words from a trading coach, right? But 9 times out of 10, when I ask a trader this question, I'm like, hey, you're in a rough patch. Can you tell me whether it's natural or self-inflicted? Let me go through results and see what you did. They're like, yeah, I took about 10 bad trades. I'm like, okay, well, why'd you take those bad trades? Well, some of them were just like by mistake, like, I read the thing wrong or I forgot a rule. But some of them, I just took it because it felt good. I'm like, yeah, okay. Now go back and eliminate those trades that you made mistakes with, and then let me know if your last month was good or not, okay? Man, Akil was profitable. Yeah, I bet it was. But again, staying disciplined is hard. Staying disciplined for long periods of time is hard, especially in an environment where, thanks to social media, everyone else is always making money hand over fist at every single second of the day. So it's natural to feel behind, like we're missing something, like we should be doing something. And it's really hard to kind of ignore those feelings. But you must ignore those feelings. You ignore those feelings, you must. Oh, gosh, okay, that's 0 for 2. I'll try one more time and 3 strikes and I'm out. All right, here's one. This is a good one. Trading will always be there. I first traded in 1999 to 2001. Life came fast. Married, kids, built a business. Now I'm semi-retired and started trading again. And I think this is a cool one because I think we forget the idea that we don't have to be successful now or that we can have second chances in the market, right? a lot of traders will start and they will struggle and they will fail, and that's the natural progression. Some will kind of fight through that failure and go through that conscious incompetence period and find their ways to glory. Some people will be done forever. And I think a lot of people think that, hey, if I failed once, I can never be good at trading. But I can tell you that I work with a lot of traders who have failed, and I've gotten messages from them 4 or 5 years later saying, hey, Akil, I revisited trading. I'm at a different point in my life. Actually, I think there's a podcast coming out on this. I have it somewhere, and I should make sure I actually put it out. But hey, I'm at a different point in my life, and I wasn't mature enough, or I wasn't ready, or whatever it was. It just wasn't the right time before. But now that I've revisited things, I'm ready and I'm locked in to become successful. And I just want you guys to remember that there's no timeline on trading. There's a timeline on life, so you got to get started at some point. But just because you're not successful now doesn't mean that you can't take a break, handle some other issues in your life, and then come back and be successful later. Something that we tell a lot of traders when they ask about trading is, so every once in a while we get an email from some person that's like, hey, Akil, I'm in a bad financial situation. I don't have any money to my name. I've got a lot of debt, but I'm interested in learning how to trade because I see this as my way out of it. And we're like, no, go home. Like, one, I don't want to take your money. You're in a very bad situation right now. The last thing you want to do is spend more money on this. But two, if you come into trading with this mindset, right? The mindset of like, hey, I need to make money, because that's all this mindset is. You failed before you've already began, because you're not going to look at the markets objectively. You're not going to look at it as being disciplined and patient and letting my law of large numbers, pan out. You're looking at it as like, I got to make this money on every single trade because my life depends on it. And that's a real gambler's mentality. And when you have a gambler's mentality in trading, you're going to fail. You're going to fail in the markets from a trading perspective, right? We always tell traders that, hey, it's going to take you probably anywhere between 6 to 18 months to become a consistently profitable trader, and much more weighted towards the 18-month side, meaning that you need to give yourself enough time to learn how to trade. You need to give yourself enough time to build or develop a strategy. You need to give yourself enough time to back test. You need to give yourself enough time to demo trade. You need to give yourself enough time to live trade and be really, really bad until you finally figure it out. So if you don't give yourself enough time and you rush through each of those steps or skip some of those steps, you're going to lose. So understand that sometimes when it comes to people in those situations, we tell them, hey, go home, take a year. Here's some advice where you can figure out your personal finances, come back in a healthier financial position, and then we can get into trading. And it's really cool to see a lot of people actually do that. Kind of an extreme story. I was mentoring a guy in jail once. This guy was in jail. I don't know what he did. I didn't ask. I don't really care. But he was on good behavior, I guess, and he was allowed a certain amount of internet time per day or per week. So I think per week. So he said that, hey, Akil, I'm in this program. I get a certain amount of internet time a week. I'm going to take your course, and I'm going to watch one thing per week, and I'm going to study it for the whole week, and I'm going to go to the next thing, right? This was the old school kind of 12-week transformation style, where my original training course, you were only offered one training lesson a week. And it's not good for you guys because we would only take in clients every 5-6 months, but it was good for clients that were there because it forced them to really lock in. So I'm working with this guy, and at first I'm like, all right, I know people in jail, they be saying stuff, right? But he was consistent. He would send me an email each week. He would tell me what he was working on. He would send some charts and be like, hey, let me know if this is good. He would tell me that all the emails are being monitored just in case I was going to say something, crazy. He said, Akil, you gotta stop calling it the kill zone. I'm like, you gotta get to the kill zone. And they're monitoring it, man. They don't know that this is a trading term. You gotta say something else. So the potential reversal zone is what we started calling it. But anyway, so he had this plan where he was out, I think, in 5 years. And again, this is an extreme case. He was out in 5 years, but he was planning on learning this skill, eventually getting his finances in order so that in 5 years, when he was finally released, he actually had something that he can do. And you're not going to believe this, but 5 years later, I got an email. he was out and he was trading. Now, I haven't heard from him in a while, so I don't know if he went back in or what, but he did get out and he did start trading, and he didn't have a lot of money, but this was a skill that he can use to kind of just give himself some type of supplemental income, because as I can imagine, being an ex-con, it's a little bit difficult to get a regular job. I think he ended up being like a truck driver or something like that, and ended up trading on a daily chart. But yeah, anyway, the markets were there for him, even if he couldn't do it right at that moment. All right, got a few more for you. Almost done. When your gut and your charts disagree, trust the charts. Yep. No gut feeling. Trading intuition is real, but do not use it. So trading intuition comes from experience. So if you're a new trader, you don't have intuition, you have gambling butterflies in your stomach that make you want to go. For those experienced traders, we do have intuition, right? Intuition is a combination of everything we've observed in the market subconsciously without even knowing that we've observed it. So then when we see something again, we're like, I think that's going to go up, because we've actually seen that pattern before. By the way, trading is all about pattern recognition. Everything is a pattern in the market. It repeats itself. We've seen that pattern before, but we just can't put our finger on it, right? Me and my wife do this game every night into bed. Not that game, guys. No. Where we watch TV shows, and then we always see like this actor or actress, and we're like, you look familiar. Where have I seen you before? And then we go back to like a movie from 20 years ago. Oh, you were that child actor in Sandlot. And oh my gosh, that's crazy, right? So we knew who she was, but we didn't actually know who she was, right? So we don't want to trade off our gut. We only want to trade off our plan, right? Always have a plan and follow it, right? But what we can do as traders is we can turn our guts into a plan, right? So what we do is we have to first understand, why are we getting this gut feeling, right? We know the gut feeling is because I'm seeing something that I've seen before, and I know from seeing it multiple times that it does certain things. And going back to the journaling advice, this is why we journal, not just our feelings and thoughts, but we journal on the technical side of things as well. So when you see something in the market, you pay attention to it. What gave you that gut feeling? Okay, that was a breakout of a key level of structure, and the candle was a high momentum candle, so a large candle, and the close was at the very top with a long wick to the downside, and then price went up. Or let me just write that down, okay, or take a screenshot, right? And then you know, next time it happens, you do it again. Okay. Next time it happens, do it again. Before you know it, you open up your folder of screenshots, and you've got like 20 screenshots of the same thing. And then if you're smart, you're like, wait a minute. I get this gut feeling every time this specific pattern happens. And every time this specific pattern happens, I feel like it goes up. Maybe this is something I should trade. And then you trade it. No, I'm kidding. No. Then you got to put it through the strategy development process, right? You've got to develop a hypothesis and a rules-based kind of plan to trade it, right? If this, then that, if this, then that. Then you've got to test it, because a lot of the times we like to see winners and ignore losers. So we'll have 10 screenshots every time it wins, but we won't pay attention when it loses, right? The faults of being a human being. So we have to test it and make sure that it's true. And then only after we do that, then we can add it as part of our plan. Many of you guys see me on the videos, and I use a volume profile tool. That's the volume that sticks out sideways, right? Did a cool video showing you guys how to use it as well. I don't think you guys knew this, but I actively tracked it for a year in every single day before I added it to my my arsenal, right? We get a good conversation on Arsenal this morning in that draw against Wolves. I'm not an Arsenal hater, sorry, but I do want entertainment in the Premier League table, and I'm not a big Arteta fan, so I think it would be fun to see them blow it again, especially in probably the weakest year of the Premier League ever. So Arsenal fans, don't at me, but I know you're getting nervous. My buddy's an Arsenal fan. I'm about to send him a text. What happened, man? That lead is getting smaller. Anyway, don't trust your gut, trust the chart. All right, 3 more. Yeah. You can lose more often than you win and still profit greatly. Most new traders cannot get around lost trades. Emotions lead to quick decisions. Focus should be on systems with personal back-tested data and keeping to long-term profit. So again, law of large numbers again, but the bigger one out of here is that we do have this misconception that we have to win more than we lose, and that we have to win a lot more than we lose. I remember when I first started trading and getting into kind of the public space here, and I would tell traders, hey, I'm a 55% trader, guys. They'd be like, well, Akil, there's no way you can be profitable because the internet tells me that to be profitable, you have to be like a 70, 80% trader. And as human beings, because of all the tests that we took in school, we know that, hey, if you get a 50, you fail the test. If you get a 60, you fail the test. If you get a 70, you get a C. C's get degrees, but you're not doing too great. If you really want to be good at something, you have to at least get an 80 or at least get a 90. So that's ingrained in us being like, well, I'm a loser unless I win 90% of the time. But the truth is the markets aren't like that. And the truth is a lot of your favorite traders out there, and not like internet people, but like real actual traders, they lose just as much as they win. And many of them lose more times than you win. There's a great book called The Way of the Turtle, which by the editing, you can tell I had the hardest time finding. But this is a book about Curtis Faith, who's one of the turtle traders. I'm not going to get into the whole turtle trading thing, but if you get a chance, Google search the turtle trading experiment. It's pretty interesting. We've done something like that, something similar in the old days of before tier one trading, before trade empowered, back when it was triple threat trading. But essentially, the turtles were trend continuation traders. They let their profits run and cut their losses short. And because of that, they were very, very low win percentage traders. Many of them would consistently take like 15 to 20 losses in a row. Their win percentage is like maybe 20, 30, 40% for many of them. But they were very, very, very successful. Some more successful than others for reasons discussed in this book, Psychology and Discipline. But the fact is that they weren't high percentage winning traders, but they made a lot of money. So going back to one of the things about knowing thyself, something you need to understand about yourself as a trader is where is your sweet spot, right? Where is that spot that you need to be at in order to be comfortable, right? We want to fit our trading style around our philosophy and personality, right? So one, it's our belief about the markets, right? That's one thing. But two, we also want to fit it around our lifestyle and ourselves. So, for example, I know that I don't have to win more than I lose, but there is a level, and my level is like 40%. So if I were to create a strategy, I can probably stomach a strategy as long as it has a 40% win percentage. However, if I were to trade a strategy that had a lower than 40% win percentage, the DKC, which many of you are familiar with, I am going to mentally struggle because I can be okay winning 6 or winning 4 out of every 10 trades, right? That's not bad. But to win 3 out of every 10 trades, to win 30 out of every 100 trades, to win 300 out of every 1,000 trades, that's kind of iffy. And I know I'll go mentally crazy. The same thing can be said for risk reward. I have to have a 1-to-1. So when I'm in a trade, I have to know that I can at least make whatever I'm risking. If I put myself in a position where initially I should say my reward is lower than my risk, I'm just going to freak out. Now, part of that is the numbers as well. And hopefully I'm showing you a little risk reward matrix on the screen in front of you. But the point is we want to know ourselves and create our trading strategy around you. My good friend and my partner, Jason Greystone, he actually requires more than 50%. He's like, look, I'm not comfortable losing more than I win just mentally because I go all crazy. So whenever he creates a system or strategy or does backtesting, he has to ensure that those results hit at higher than 50% or else he can't trade it, even if it's a very profitable strategy. So yes, we do have to understand that you can be all over the place as far as win percentage goes. It doesn't really matter. What matters is your return on investment and your edge. But win percentage does matter for you personally in your comfort level, because if you're in a place of uncomfort, you're likely to make more mistakes, emotional and lack of discipline mistakes, and then you're just going to malfunction as a trader. All right, the penultimate one. This one was actually a list of trading rules that someone put in. I'll put it up on the board, but for you guys listening only, it says simplicity plus consistency equals results. And there are a few things they note. I'm just going to read them off. I'm not going to go too much into them, but don't be a hero. Don't fight the trend. And again, I don't necessarily agree with all of these, right? But I'll read them to you. Don't be a hero. Don't fight the trend. Reactions are greater than predictions. Win big, win small, lose small. No big losses, no average down, no averaging down, meaning that don't add to your losses while they're losing unless it's specifically in your trading plan. Like as price goes against you, don't like invest more to make it back up. Only price pays, ignore the noise. That has to do with everything else around trading. I'm a technical trader myself, so although I understand the noise does influence price, all my decisions are made off the price charts and not trying to make predictions of what's happening on the funny mental side. I'm not sitting back, will Trump bomb Iran this weekend or will he not bomb Iran? No, it doesn't matter. I'm going to see what the charts say for that. I hope he doesn't bomb. I'm not about war, but anyway. Complacency is the thief of profits. Ooh, that's a good one. Yeah, sounds like a t-shirt. Oh, I'm on here. Plan your trade and trade your plan. I made it, guys. I made it. I like to thank the small people that were here the whole time. You guys that were with me before Trading Coach Podcast 000, which is the secret episode that many of you guys don't know about. I appreciate your support. We made it. Lose your opinion or lose your money. That's another good one. These are gems. I'm reading this for the first time. Lose your opinions or lose your money, meaning that your opinion doesn't matter. The chart matters. Who cares what you think? The market doesn't give a F about what you think. So trust your plan and trade your plan is what that means. Better late and right than early and wrong. Yep. No overnights, no earnings, no lottos, no FOMO. So that means like don't do risky stuff. And on the other side, these are some good ones for more of the non-technical side. Focus. Yep, we talked about the most dangerous time to be a trader. You can go check out that podcast if you haven't already, but it has 100% to do with focus. Drink water. Water's good for you, yeah. Check your posture, as I'm checking mine now as I sit here. So I got the standing desk despite me sitting today. Monitor your breath. Just had a coffee, so it's not the worst, but it's not the best either. Check emotions. Check heart rate. I actually, I'll read the last one. Document in your journal. So heart rate, real quick, not to get on a whole soapbox. I used to wear a Whoop, right? I don't know if you guys know what that is. Many of you guys are with me when I wore it. It was one of those activity bracelets. They have the ring things now. And I wore it for, I was trying to be better at sleeping and actually getting good sleep. I was going through a period of my time. This is when I had kids. Someone's calling me. This is when I had kids and I wasn't sleeping that much and I was getting like sleep deprived and it was affecting my trading. So I was like trying to figure out how to get better sleep patterns and whatnot. But I also started noticing like I would get these elevated heart rates during my day trading hours. So meaning that like it tracked your heart rate and I'm like, man, why is my heart rate? Obviously when I'm working out, my heart rate is high because I work out hard, right? But I'm like, why is my heart rate so high between like 8 o'clock and 10 o'clock in the morning? Like, what is happening here? Is it the coffee? I'm like, no, I drink that at like 7. I'm like, oh, duh, my day trading hours. I'm in a highly stressed environment. I don't even notice it, but I'm sitting here freaking out. And that's why my pits are sweaty at the end of each day trading day. And it was just it was information that I didn't know existed. So it allowed me, again, finding out information allows you to create solutions. It was something that allowed me to start, okay, well, maybe I should change my pre-trading routine. I started taking more breaks instead of staring at my computer for like an hour at a time. I started shifting breaks to like every 35 minutes, every 45 minutes to like take a lap around the house, drink some water. It was, I didn't dig in as much to see like what my heart rate was like during like an actual live trade because typically I don't really look at them. Or I don't have an alternative from day trading not to look at them. But it was interesting information about your heart rate, which I thought was pretty cool. All right, last one. I'm going to get you guys out of here because it's been over an hour. Oh, or about an hour. I'll edit it down below an hour, I promise. Do something else for a living. And no, they're not telling you to quit. I don't think. They might be telling you to quit. It could be a troll, but I'm going to take this and flip it to a positive, right? Do something else for a living. This means that despite my story, for you guys that listen to that secret episode 000, despite my story of quitting 3 jobs and going into full-time trading, jumping off that cliff with no parachute, I think it was a very dumb decision. Now, again, I've told you guys before, I get lazy. I am motivated by jumping off a cliff and being told either die or figure it out. So I needed to do that to really take trading seriously because up to that point, I was dibbling and dabbing and losing money, but not taking it super seriously. But I would not advise anyone do that because if you put all the pressure on yourself to be a trader and to make money and provide for yourself or your family from trading, you're going to be like an example I gave you earlier with the guy that doesn't have a lot of money. You're going to be in a position where you have to be successful right away. And that means you're going to rush through the process. It also means you're going to put a massive amount of pressure on yourself. And the more pressure you put on yourself, the worse you're going to be as a trader. However, when you can do something else as a living and have trading kind of be your side hustle, meaning you have a full-time job that provides your income, your bills are paid, your food's on the table, now you can actually be patient with your trading and develop it the way that you want to develop it. And the best story I have to end you guys on is a trader of mine, and this was another like 3-4 year plan where a trader was learning how to trade and he wrote me through his 4-year plan. He was like, hey, I'm going to learn how to trade in year 1. He said, year 2, I'm going to get a full year of consistently profitable trading. Year 3, I'm going to cut down to cut a quarter of my hours out of my job or a third of my hours out of my job and then replace that with like day trading. And then I think year 4, he was going to go like half-time at his job and half-time trading. But I think his job was doing layoffs anyway. So I think they bought him out or something, but he got good enough at that point to be a full-time trader. So it kind of worked its way out. But the point was he was slowly kind of removing, if this was trading, no hours here, job, full-time hours, he was slowly reducing the hours of his full-time job while increasing the hours of his trading, reducing the income from his full-time job and increasing the income from his trading till he was here. And eventually he would go here. This is going to be make for a really cool still shot if I use this for the thumbnail here. But yeah, so I don't know if this guy was trolling or not, saying do something else for a living because trading is a scam and no one can be successful, blah, 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 right? But I think it actually is good advice. Now, I hope you guys are taking notes because I told you at the beginning, I want you to list the 3 best bits of advice that you took from what I told you over the last hour, or if there's a piece of advice that I didn't mention, or maybe just the best piece of advice that you think you would have as a trader. So write it in the comment section below because I want to take them, I want to tally them up, and I want to create a poll, and then that will be the final declaration of what is the best piece of trading advice. I promised you one more Yoda before I completely strike out. So your plan trade, trade plan your. Take care.